Good afternoon. It is Tuesday, June 30th, 2:02 p.m. Eastern Standard Time. I am posting another podcast today. This is a pep talk because morale is, if in certain sectors in the market, morale sentiment is buoyant. In others, it's rock bottom, and including some of the value stuff that we traffic in. We've had some other tech exposure, so we've seen both sides of it, but the value names have been really out of favor, and I've heard from more investors than I have in a long time. You have to go back to the second half of 2019 and the first half of 2020 to see sentiment where it is. And why is that? Well, I mean, it's natural. It's price action. Um, the ironic thing is the economy is much stronger than where it was in 2020, 2019. It's much stronger than where it was in 2000, and it's stronger than much stronger than it was in 2008 on much more solid footing. So there's you know money has momentum dominates everything. So money has flowed into tech, and if you extrapolate that, um, the market, crypto topped last October. That was, we had a big topping process in crypto. Precious metals, the gold, silver, platinum, palladium, they peaked in late January, January 30th, more specifically, my late father's birthday. So he didn't have anything to do with that, looking down from above. But you had a lot of money come out, and you've had a big downturn in precious metals and the precious metal equities the last 5 months. And tech had originally topped with crypto in October of last year. A lot of the secondary tech names came down, but when the markets kind of bottomed March 29th, March 30th, tech is shot out of the starting gate, led by the semiconductor stocks, memory stocks even more, which have, believe it or not, the memory stocks like SanDisk and Micron have quadrupled, from their end of March levels. Um, so and as that's happened, so end of March, it was, looking back, we saw, a rally on March 30th and 31st, and that kind of was the precursor to this tremendous rally we've had in the broader markets in the second quarter of 2026. Tech is led, and so as we get to the end of the quarter now, everybody wants to show that they've owned the tech names, right? And then nobody wants to show that they've owned, some of the underperformers. And so you're seeing, buying pressure ramp, into the closing print here. The last 2 days, we've had pretty good rallies, and notably in the tech names. And then on the value side, some of those stocks have really struggled. So that's just quarter end positioning. It's a function of kind of what happened during the quarter. But the good news for the value and the economic sensitive stocks is that, again, the economy is much stronger. The Red Book sales at the end of June were higher, 10.5% year over year. This is a private survey of same store sales, and its averaged growth from 2005 to 2026 is 3.9%. We had some outliers on the downside in 2020, on the upside and the rebound in 2021. But as far as sustained growth, this is as good as it's gotten over that period. Um, so, and there's been some talk in our group and in chat that, hey, we might be in a bubble for the tech stocks. If it bursts, what happens? Well, in 2000, 2002, the NASDAQ went down 78%. The composite went down 78%. Even leading stocks like Amazon were down 94% from their peak to bottom. But a lot of value stocks went up during that time period, and that was relative strength that then led to we really had an upturn in value in 2003, 4, 5, 6, 7, and then in 2008, tech quietly outperformed. Large cap tech quietly outperformed. So with the economy so strong, even if the tech bubble, led by the memory stocks and the semiconductors, loses its momentum here, there's a good chance that in 2000, 2002, we barely had a technical recession. That the technical definition of recession is negative GDP growth for 2 quarters in a row. We barely registered that. This time, I actually think economic growth is accelerating. And then the housing market is on much stronger footing than it was, obviously, going into '08. It's more akin to, I know that Alan Longborn says that we're at the end of the housing cycle, but you've had some regional weakness, particularly in the stronger markets like Austin and Phoenix and the Southeast. You've had some regional strength in the Midwest and Northeast where there hasn't been as much building. But in general, the housing market, it's really good for monetary policy here because almost 40% of the CPI is housing or the housing equivalent rent. You're going to get some downward pressure from that, and that lowers the headline CPI rate. So, and if we do get rate cuts, further out in this year, or the market's pricing them in 2027, it could be very stimulative for an economy that's already pretty strong under the surface. So, we've obviously had, the economy and the markets can be two different things, right? And, money's really concentrated, much more narrow than it even was in 2025 out of the tariff downturn. But we're starting to see quietly, we're starting to see some broadening of the market here. I know the housing stocks, I wrote the Too Cheap to Ignore article on restoration hardware. That's had a nice bounce. Housing stocks in general have bounced here. Even as of when I was writing my notes out for this article, the small cap value, it's up 22.7% year to date. The Qs are up 20.1. S&P is up 10%. The developed international markets, EFA, are up 9.8. The emerging markets index, EEM, is up 25.7. But that's, it's kind of like our market here. There's three stocks that are dominating that: Samsung, SK Hynix, and Taiwan Semiconductor. You take those three out, it's very much a bifurcated market in the emerging markets. And for example, the Korean market, which Samsung and SK Hynix are a big part of, is up 107.7% year to date as of this note. And the Brazilian market is up 9.9. So big, disparate differences. The emerging markets are very much like our markets in the U.S., a very bifurcated market. So I remember when I was at Schwab in 99, 2000, I worked there until 2002 before I was the director of research at Redwood. I was an advised certified representative at Schwab, and we had, I got my broker licenses, and you had to sit with clients, hang out with clients, and we would go over portfolio strategy. And I remember I was recommending Realty Income, which is ironic because I've written in my Public Seeking Alpha, and there's a series of, Realty Income has gone nowhere, starting in 2017. But at the time, REITs had been really out of favor, and nobody wanted to own them. I remember that. I remember sitting down with clients. I was just young at the time. I'm pushing 50 now. Back then, it was 26, 27 years ago, so I was a young kid. And I got letters from people, though, because that had thanked me, because we had reorientated their portfolios, and REITs really had a tremendous period of outperformance. But the point of the story here is, at the time, REITs had healthy dividend yields. They had been out of favor for a long time. Nobody wanted to own them, right? And you see that now with some of the, what I call the economically sensitive value stocks, including things like Cleveland Cliffs or the coal stocks, even like the natural gas equities. Their balance sheets are great. The valuations are really compelling, and they're actually, if you think, I'm actually rooting for the data center build out here in the U.S. because that is bullish for the economy. It's bullish for the energy that goes into those, natural gas in particular. But if you look at the valuation, something like Bloom Energy is 30 times sales, maybe 20 times sales if you factor into its growth, whereas Antero, EQT, Expand, their balance sheets are really good, especially Antero, and the multiples are they're very attractive starting multiples. You're not generating any free cash flow at Bloom Energy, but nobody wants to own those. People don't want to own Peabody or Cleveland Cliffs. They don't want to own. There's a lot of stocks in the market that haven't done well since 2021, and things like Charter that we've talked about that is a really compelling free cash flow yield. A lot of value investors have got hurt in Charter and Comcast. People don't want to own these because they haven't performed. And if you bought them a year ago, or if you've held them here this year, and you're watching, the price action that is levitating or just exploding, it is demoralizing. So you can understand where sentiment is at. It felt very much that way, at these other turning points in the economy. I wrote an op-ed for the Wall Street Journal in 2007, and my colleagues at the time thought I was nuts. I said that Countrywide, the purpose of that op-ed was that Countrywide was exasperating the run-up in housing prices through their mortgage loan limits, which they had grown those very aggressively, and I was almost shamed, by my own peers and my colleagues for writing that. And similar, the realty income recommendation in 2000, REITs in 2000. So it's natural at these historical inflection points that you just feel, the weight of the world. And if you're in some of those stocks early, it can be, that sentiment being so low, is depressing, demoralizing. It's hard to stay the course. So, but historically, when sentiment gets to extremes, whether it's too bullish on something, and I think of the Jim Grant. He had that story in his podcast where he said, he had a young family in the early 1980s. He had to stand in line to buy gold. He said, anytime you have to queue in line for an investment, it's probably a bad, spot to be in. So think of the people who are queuing in line for certain things today. And then, if you can own the things that nobody wants, especially when they're really attractively valued, the forward returns can be very good on a relative and an absolute basis. So hang in there. I'm trying. I mean, it's somebody who follows market history, and I try to take advantage of some of these things, and it's tore me up too. You know, um, and but that's natural again. So and you can imagine. Hold on, I'm gonna take a sip of my watermelon juice here. You have some ice in there, but you can imagine that the pool we're playing in, is the same pool. We didn't go long oil. I've actually tried shorting oil, which was the right call, but it was very difficult from a timing perspective to get to. But um, those guys, a lot of those guys, they own you know stocks in the base metals, precious metals. They own value stocks. So it's as and a lot of people really went aggressive long oil with options. So as their portfolios have taken that drawdown, they're natural sellers. So I've joked that we're in the wrong swimming pool right now, the wrong swimming hole, the wrong lake. You almost have to get those guys out, or I mean the leverage instruments have to run their course, and then you're going to be back, to a better starting point. But it's been difficult. I'm not going to sugarcoat it, you know. However, the silver lining is that historically, when you feel this way, there's a lot of opportunity, and so you have to keep an even keel. Don't get too down, and just weather the storm. So, just want to give a pep talk. Also, want to say I've been, this is a product placement here, no sponsorship, but I've been using it. It's Dream Tape. It's a sleep tape. They're like these size. Basically, you put it over your mouth when you sleep at night. It forces you to breathe through your nose. Some of my family members in my household have said that I've snored at times, but this cuts that out. I think it gives you a deeper sleep at night. Um, you know, your family may not like it. You can't talk once you put it on. So that's the downside or upside, depending on the vantage point. But I think it's really helped from a health conscious point of view. There's different, I know there's different tapes out there, but look into that. I know people use different things to help them sleep, and that's an easy first step. That I found has made a big difference. So, and it forces you breathing through the nose. It forces nitrous oxide, your body to generate nitrous oxide, and it's I've had restful, deeper nights of sleep with that too. In addition to keeping the thermostat lower, which is hard now because it's in the 90s here, But consider that and just take a day at a time. Try to get through the period we're in now, and think, of the opportunity that's in front of us. If you can, and I always say, Mr. Market, Mrs. Market, they try to punish the most amount of investors, and so they get people, and you saw it again, circling back. Everybody was bulled up on crypto in October. Everybody was really bullish on precious metals, gold, silver, precious metal equities in end of January. And normally, as you've seen with those, when you get that level of exuberance, the other side of that is a downturn. We haven't seen it with tech yet. Tech's been very resilient, but the valuation multiples are immense. And nobody's doing that math right now because it doesn't matter. Fund flows are dominating everything. In fact, today I was talking to some of my friends, and they're buying. People are buying zero DTE calls because the last 2 days, because they know, the markets go up into the end of the quarter. And I said, that was from a probability standpoint, yeah. But those are, day trades, and you have a whole, there's a huge percentage of the market that's doing that. And that's why you're getting a lot more volatility these last 16 or 17 trading days. We actually touched on the QQQs. We touched the 50-day moving average on Friday, on the downside. Then we kind of touched it again after the rollover on the Monday morning trading yesterday, but we bounced really aggressively. But that's just characteristic of what's going on with the markets right now. So there's a lot of volatility. And just understand that, and understand that where positioning and sentiment is, and that can help you get through this journey that's not easy at times. Take care, guys, and have a good Tuesday.